It's an honor to introduce you to the family office panel. So Vanderbilt, Rockefeller, even the royal family, they're all family offices. They carry a bit of mysticism, but also they're a stabilizer for our economy. They are very different than most investors that we meet or see today. Most investors are a short-term investor. They like to choose and pick stocks. Family office are more permanent capital, and that's what creates that stability. So we're very honored to have some with us today. And then I'm Stefanie Crosby, and I'm also one of the board member of the International Economic Forum, the World Strategic Forum. And when it came to talk about family office, I could not think of a better person to be the moderator. So he started with writing deals on napkins, and now he's at $2.5 billion under AUM, and he co-invests with family offices. He doesn't charge management fee or carries, but he found a model that worked really, really well for the family offices. So it's my pleasure to present you this panel. Good luck.
My name is Nick Bakish, co-founder of RMC, platform for family offices to co-invest. We work with about 300 different families across the world. And so to open up the panel, I'm going to start with one of the most cliched things that I hear all the time when it comes to the world of family offices, that if you've seen one family office, you've seen one family office. And so what I would think would be very helpful is everyone gave an introduction of themselves, what their role is specifically, and talk about how they came into the space. So we'll start.
We'll swap. Steve Fradkin, I'm the president of wealth management at Northern Trust. I've been at Northern Trust for 37 years, and there was no vision to get into wealth management. It just, probably like many people in this room, it just happened. And in the family office space, we serve, in terms of the biggest family offices, about 500 families representing just under $1 trillion.
Hello. My name is Marcelo Hernandez. I'm a senior advisor to the Dassler International Family Office. My background's been over 40 years in the international wealth management area. Before joining Dassler, I had spent 13 years in Nassau, Bahamas, in the international banking, mainly concentrating on Latin America.
Good. Good morning. My name is Vik Margol. I am the managing director for a personal family office of a Texas environmentalist and businessman, Trammell S. Crow. In addition, he and I launched a private equity firm called American Resilience Partners, which I'm the CEO of, which is a private equity firm focused on sustainable mission-critical infrastructure, sustainability as a way of driving profitability and value enhancement, environmental resilience, and what we call the industrial re-revolution through clean technology. And then my third role, so as you guys know, a lot of people in family offices wear multiple hats. My third role is also helping support an environmental nonprofit that Trammell founded called EarthX, which in 2019 was one of the largest environmental celebrations in the world in Dallas, Texas. And they just launched a TV channel called EarthX TV as well.
Hi, everybody. My name is Ben Wolkon. I'm with MUUS Climate Partners. Vikram and I, in some ways, are like brothers in arms. About 6.5 years ago, I was hired by MUUS, which is the family office of Michael Sonnenfeld, many times over successful serial entrepreneur and philanthropist, who's best known today for being the founder and chairman of the investor network Tiger 21. He had about a 30-year track record in the environmental and climate space. I happen to have a shorter track record in that space, and he hired me to be their dedicated, originally called Manager of Sustainable Investments. And our journey over the last 6 years has led to launching MUUS Climate Partners, which is a dedicated team of 6 people, 6 extraordinary people who have all been in these spaces that need to be decarbonized or have their greenhouse gas emissions reduced. We now have an internal venture fund. We've also taken on external capital, all focused on the nexus of advanced technology and climate change. We've backed about 30 companies over the last 6 years.
My name is Shaun, Senior Vice President of Advanced Planning and Sales for National Brokerage Atlantic. We are a family office-owned business. I've been in the wealth management space for over 14 years, doing structured finance, investment management, and life insurance strategies focused on tax mitigation, asset protection, and estate planning. Prior to that, I came from the real estate space, where I ran a boutique consulting firm where we raised debt and equity for the acquisition and development of commercial real estate projects.
Thank you all very much for the introduction. So we'll start it off with just an assessment of the current environment that we're in. We'll probably all agree that the last 12 months has changed a lot of what we took for granted. In my investing lifetime, I haven't experienced inflation the way we have and rising rates. So the typical kind of 60-40 that family offices don't invest in, really hurt a lot of people as rates went up and bonds went down. So given that we're facing these new macro kind of headwinds, I would ask, how are you guys adapting to a world of, inflation, higher rates, just more difficult macro to deal with? And how are you dealing with that specifically as a family? And what kind of strategies can you share with the group?
That means I go first. Well, I guess being a little bit older than some on the panel, this is and some in the room, it's not the first rodeo in terms of gyrating markets. It feels like it for some, but capitalism is all about the search for opportunity. And, if you think about it in historical context and you go back, many, many years ago, it was 60-40, 40-60 stocks, bonds. And there's been a progressive granularization in the search for opportunity, whether that's international emerging markets, high yield, different sleeves of private equity, different sleeves of hedge funds and commodities and so forth. And so as the environment pivots, I think we're seeing all clients reevaluate their investment policy, reevaluate what the long-term algorithm looks like or what they think it looks like, and adjust. And so some of the things that we're seeing are for taxable investors, they're focused on tax loss harvesting and trying to minimize their taxes. They're focused on yields on cash, which in more recent years were pretty low, but if you have substantial cash holdings, they're thinking about it. They're taking a harder look at alternatives, both upside opportunity and concern. And there's still a lot of conversation around ESG, climate, diversity, and so forth. So those would be a few examples that we at Northern Trust are seeing.
Thank you.
I agree. We touch on all those points with our family office members. We're a multifamily office. We have over 50 clients. There's been a lot of hand-holding lately due to the situation, especially the inflation. Looking for alternative investments. Most of these people that I deal with are from Latin America, and they're very conservative. I mean, they've taken most of their risks in their own businesses. So when it comes to investing in foreign markets, they turn to be very much on the conservative side. What's the conservative side? Fixed income. Fixed income has completely been demolished lately because due to the rise in interest rates. So we're looking at other alternative, such as private equity, more on the value stocks side of the portfolios, to give them that that yield that they're going to be missing now. So
I think it's also important to mention it depends on what type of family office you are. So some family offices that have an operating business where a lot of their capital is held up, and so if they're continuing to run a business, if it's real estate development, consumer products, whatever it may be, or versus if your capital's in the markets, I think it has a significant impact on what your strategy will be going forward. For us, I mean, a lot of it is managing cash, just understanding what are the best opportunities to the point mentioned earlier from an investment standpoint. I mean, if you see about the amount of capital that's being pulled out of the public markets or also in the private markets for certain industries, this is a tremendous opportunity for family offices who typically have more of a long-term hold horizon versus your average investor. So seeing that as an opportunity is what a lot of family offices, at least the ones that we work with.
I think where you stand depends on where you sit. And heading into the economic headwinds that we're probably heading into today, the way that you would respond to that would depend on the asset class that you're focused on. So you would treat real estate different than you would treat hedge funds, different than you would treat public equities. We're in a pretty unique situation where on the private side, we're basically singularly focused on this enormous opportunity and enormous challenge of climate change and decarbonization. So are there any mathematicians in the audience? Can anybody tell me what 7 times 12 is? Anybody? It's 84. So at the end of the year, we will have 7 years or 84 months remaining to cut global greenhouse gas emissions in half. So no matter what's happening in the stock market, no matter what's happening with policy, no matter what's happening in elections, the world scientists are saying we have 84 months to cut greenhouse gas emissions in half. We are not on pace to do that right now. However, the US just passed the biggest economic policy that has passed in a half century, focused on this issue of decarbonization, which will get the US to about 2/3 of where it needs to be by the end of the decade, according to most analyses. So we're investing in companies that can hopefully accelerate that transition, that can apply advanced technologies such as AI for the power grid, such as electric and self-driving cars, such as next generation renewable power providers that can provide renewables in a way that it actually displaces fossil fuels at the time that it needs to. We're backing those companies, hopefully using the family office's connections to open doors for them and help them scale. And if we're doing our jobs right, we're helping that happen on a faster timeline, which is good for both impact and enterprise value. So of course, I'm only speaking to how we're focusing on that one asset class, but I think a response to this economic environment needs to be specialized and tailored for each asset class that you're focusing on.
Actually, I'm going to jump in on this as well, just as a follow-up point.
Yeah, we don't have to go in order. So
No, I mean, it's just interesting because obviously the climate transition, climate change is an important topic for a lot of family offices, but a lot of people, especially in Texas, sometimes unfortunately are skeptical on it. And the point that I wanted to make, though, that there's a tremendous investment opportunity related to the green sustainability transition, which I'm sure we'll talk about later. But there's also a tremendous investment opportunity related to sustainable mission critical infrastructure. Yeah. These are industries that tend to be recession resistant, and these are industries that we as Americans, people around the world rely on. Power generation and transmission, water, energy infrastructure, agriculture, healthcare, safety, transportation logistics, IT and telecom. Those 8 industries tend to be very recession resistant. So those are the industries that are your end markets for product or service providers. That's something that we're targeting, but it also gives you that ability to bridge into these other types of transition investment opportunities.
Vikram, you and I have spoken about this before, and it's sort of difficult to present this to individual investors, especially when they don't understand that well the environment, what's going on. And to get them to sign a dotted line to go to an investment is just not easy if you run into those types of problems.
Oh, without a doubt. I mean, trying to find people to convince them that there's value generation opportunities and something that they may personally or politically disagree with is one of the biggest challenges. And I think that's, I mean, from a personal perspective, I think that's one of the greatest challenges our country has today and around the world is how do you separate the politics from investments? And there are some serious challenges that our planet is faced with, our people are faced with, societies. And how do you see that as an investment opportunity? Is just showing them the numbers. And unfortunately, some of these new technologies are more venture-based versus they've been established. But how do you change the conversation to people realize that you have businesses that have been around for 20, 30 years that are solving these critical challenges? They may not be doing the most sexy technologies that are at the front page of PitchBook or Crunchbase, but these are true businesses that are solving challenges around the world.
And I think if you're focused on a niche space like this, you do have to accept that there's some educating the market that's just necessary. So we had a first fund that was all internal capital from the family office and a second fund that was anchored by the family office as well as all the principals. So the biggest investor is the family office. If anybody loses money, we lose the most money. But we do have some others coming in alongside of us. About half of them were groups that had extraordinary accolades in this climate space already, and half were family offices that had never touched this before. We were actually their first exposure. They saw the financial upside to doing it, the impact to doing it, the education to doing it, but there was some education that was needed. And this one call has always stuck with me where an investor called to commit $1 million and had a conversation with him that after 15 or 20 minutes, he paused and told me that he wanted to admit to me that he didn't realize that what we were doing was for profit. He thought he was giving $1 million as a charitable donation because he didn't realize that you could actually do something that was for the climate, that was for profit. We were saying, hey, we're actually trying to generate well above market returns with some of these opportunities. And of course, he tripled his commitment on the spot, which was really great. But I'm only saying that to illustrate the fact that there is some educating the market that needs to happen. But when it can be family office to family office, you get something really powerful because they don't feel like they're coming in with a broker. They feel like they're coming in alongside another group that understands them, that can communicate with them, has been through what they've been through. So when you can build these coalitions, no matter what the space is that you're focused on, I know we've completely co-opted this panel to make it a climate panel, but no matter what the space is that you're focused on, if you can create a 1 and 1 is 3 or 1 and 1 is 5 situation by bringing together families that are all focused on the same mission, it can be a really extraordinary outcome sometimes.
You know, a data point that you may all have a reaction to, since Northern Trust is not a family office per se, but serves 30% of the Forbes 400 wealthiest Americans and works with their family offices. The vast majority are in the conversation around climate and diversity and ESG. And this is not a scientific, this is sort of I'll call it an informal survey that I did internally before I came, but only about 10% have translated that dialogue into their investment policy statement. So my point would be, at least from our lens, looking at many of the most affluent families in the world, good news, everyone's in the conversation, whatever one's politics, but the translation of that into an investment approach is still, at least through the lens we see, relatively early. And
Thank you. So sorry, I'm going to rewind a little bit here, and then I'm going to get back to where you guys are talking about. Okay, let's start talking about what Nick kind of set this up with, is talking about that 60-40 portfolio and some of those challenges. What's that 40% represent? It's risk management, right? The 60%, that's the risk part of our portfolio, and the 40% is where we have risk management. And everyone in this room knows for a long time that 40%'s been an expensive asset class because most of that's going to be represented by bonds, and we've had low interest rates, right? And so I'm coming at this from a different perspective. National Brokerage Atlantic, we're an insurance company, okay? We're a broker. We do underwriting, everything else in the insurance space. So that's risk management. So if you take a step back though and look at that from like investment management perspective, and you look at, and I'm going to get a little in the weeds here, the Sharpe ratio of cash value life insurance compared to other traditional asset classes, because there's no variability on the downside of life insurance, okay? So when you look at something like hedge funds that has a Sharpe ratio, and for you scoring in the room, higher the number, the better. It's like the opposite of my golf game. And so if you have a Sharpe ratio of over 8 on cash value life insurance, and the Sharpe ratio is 51 basis points of hedge funds, that's pretty astounding. So now, if I'm advising somebody, I need them to understand life insurance as an asset class. Now, how does this tie into what they're talking about? Because life insurance offers a lot of benefits, okay? And one of them is going to be tax savings, okay? Tax mitigation. It's a big part of what we do. So if you're a family and you have exits, you have businesses that are operating, whatever it is, you have all this income coming in, well, there's a lot of taxes that come with that, right? So if we can show you a strategy leveraging different tax vehicles and different legal structures rather, and life insurance strategies, so that you can keep those dollars that were going to go to the IRS on your balance sheet and then turn around and invest it into ESG, I think that family feels a lot better as to where those monies are being allocated, where now you're investing on your mandate, and not enough people, to Stephen's point, are investing, or they're having the conversations, but it's not converting to action just yet, okay? But what we can do is we can help create the cash flow or the tax savings so that you can keep those funds on your balance sheet and invest the way that you see fit instead of investing in the government mandate.
I'm going to do my best to combine insurance and climate change because I think you can't separate them. If you think about insurance, you think about risk management. I don't think we need to look far. You look on the West Coast here, and in Canada, even, Hurricane Fiona, Ian. There's also what we've seen a lot in the last year of wealth destruction. And not just from that, but, just crypto, for example. How do you manage the risks of all these things? I know we're talking about the opportunity side, but going into a changing world, what are the risks that keep you up at night? They could be tail risks, they could be, risk in front of it, and how are you thinking of managing them from a family office perspective, but also just in general?
I think one of the risks that a lot of family offices are looking at right now is the regulation. I mean, usually family offices have not been that regulated in the past, and it's starting to ramp up a bit on the regulatory side for family offices, on the tax side, on the investment, since family offices are going more and more into the alternatives and derivatives. I think that's going to be ramping up a bit on the regulation side.
I think investing in privates generally, there's a big difference between a great company and a great deal. And in 2021, I think a lot of investors, whether family offices or others, got a bit ahead of themselves in terms of how they price companies. And we're already starting to see kind of idiosyncratic and anecdotal cases of corrections. Whether that happens on a larger scale is kind of to be seen over the next 12 or 24 months. But I do think that one of the big risks that we've seen in the last couple of years is companies, especially at the early stage, that basically get an idea, a couple of smart founders, and a good thesis and say, we'd like to be worth $100 million now. And some investors bought into that. So there is likely going to be a little bit of a correction. We've tried to be quite conservative and stay away from those kinds of deals. But I do think that it's something that we want to look out for, not just now, but in the future. I think innovation and venture capital funding is different than it ever has been before. You have a lot more individual players in the space that are giving companies those valuations. It's not like it was 30 years ago where there were 5 VCs and that was it. So the pricing of companies, especially in the private space, is something that we're quite cautious of.
Sorry. I was just going to say, let me reframe your question just a little bit differently. And I want everyone in this room to imagine the following scenario. It's 3 years ago, and you are now members of the board of directors of Northern Trust Corporation, a 133-year-old publicly traded large financial institution. And we're reviewing our plans for the coming year. And we present a plan, and it says we think the markets are going to do this, and interest rates are going to do that, and the economy is going to do this, and nobody knows, but you all sort of shrug your shoulders, say, seems reasonable. And then one of you raises your hand and they say, Steve, I just want to offer one comment, and I just want to know how management is prepared if we have a flu bug that shuts down the entire world, literally the entire world, from Australia to Russia to South Africa to America. Baseball stadiums are closed, restaurants are closed, gatherings are closed, and whatever one's politics are around this whole thing. Steve, what's going to happen to Northern Trust in the stock market? Well, first of all, that's never going to happen. But if it does, it's going to be really bad. And of course it did, and the stock market boomed. And there's a whole explanation for that we could get into. My point, coming back to risk management, is this. Whether you think about it through the lens of COVID-19, the global financial crisis, the Asian debt spiral, Bernie Madoff, long-term capital, there are many anecdotes, and we keep calling them tail events. Oh, that's going to happen once in a blue moon. But they happen sort of every 6 or 7 years. And so from a risk management point of view, I think the reminder is it can happen. And when we're in the middle of a booming period, same thing with global financial crisis. If I had said to you, well, what happens if Lehman Brothers, Merrill, Freddie, Fannie, Wachovia, Washington Mutual, if they all, AIG, if they all collapse like dominoes, what's going to happen? Well, Steve, that's not going to happen. They're AA rated and all the rest of it. These things do happen. And so when you think about things through risk management, you have to be willing to reach for opportunities, but you always have to be mindful that the what things can turn violently and quickly and unpredictably.
Fantastic. I think you should moderate the panel because you frame it much better. So one of the things I always say working with families is, one of the great aspects is you don't have to be smarter than everyone. You just don't have to do a lot of the dumb things that a lot of different organizations are forced to do because of constraints that are put on them. And so I find a lot of collaboration is helpful for people to share best practices when you don't have necessarily the requirements to do deals for the sake of doing them. When funds raise capital, they have to deploy them. And you might not have a timeline to sell where, funds, their time comes up, they have to sell, and everyone knows that it's not a great time necessarily to get the best return. How do you kind of, with your own family and other families, take advantage of less constraints than what would be on institutional capital and others in this space?
I'll start and at least tee it up for you guys. Look, I think family offices have tremendous long-term capital deployment advantages, and they're not really competing with one another. And while they often have, some have large and talented staff, they also know that they are not generally as large size as a massive financial institution, and so there actually is an incentive to dialogue with others. You're not competing with them. You often have similar long-term objectives, and so certainly what we see through Northern Trust is a fair amount of openness to collaboration. Now, we're not a family office per se, so I invite my colleagues here to give it a different lens, but we definitely see that.
Yeah, sorry. Thanks, Marcelo. No, I was going to say, I think there's a significant amount of collaboration that does happen between family offices, especially if you're from the same vintage in terms of it's a first gen, second gen, fifth gen. There's different linkages there, but as well from an industry standpoint, there's numerous times where I'll get investment opportunities that I may not have. There's a lot of times where I don't have certain industry expertise, and I'll share it with other members, other families, either because we want to look at it from an joint investment standpoint, or if we want to just share deal flow with each other. But there's that innate trust between family offices and family offices because, to Ben's point, you're not dealing with a broker. You're not dealing with somebody who's just trying to make a quick buck from you, because these are long-term relationships that have been built. That's one of the reasons why we launched American Resilience Partners, is as a private equity vehicle, as a firm, to go find other family offices and bring other family offices to the table, because we believe that family offices, given the long-term nature of the capital, can actually solve a lot of these challenging problems in the United States and around the world, especially if you collaborate with each other.
I think that's exactly right. One way that we're able to get around constraints, because of course we had a permanent capital vehicle where any timeline was acceptable to us, and now we've gone into something that's a little more narrow and a little more structured. So how do we maintain that flexibility that we used to have? Well, from a perspective of following on and continuing to invest in companies and having a more patient timeline, that can be achieved through SPVs. One thing that we're proud to be able to say is that anytime we put together a co-invest SPV, we're putting our own capital in it. And again, it's that same reassurance that we're giving in our other situations too, which is that if you're putting up capital, we're putting up capital alongside of you. We're going to be the first money into anything we do. That's how strongly we believe in it. And when you can say that credibly to other family offices, you are able to create some really great situations that you might not be able to otherwise.
So thinking about SPVs makes me think about tax, because as a Canadian investing in the US, it's quite complicated. I have to say, learning that you have to file, a local federal return, state return, and sometimes SPVs are very elegant solutions to do that. As taxable entities, family offices are quite different than endowments and others. How much is tax kind of factoring into the decision-making process, and what are the strategies might be to think about, generationally, how to optimize the after-tax risk return thought process?
Well, for us, my focus, like I said, is Latin America. So the tax situation is not, it's not, that relevant.
Not like Canada.
No, not at all. And then, but sometimes you do get clients that are U.S. citizens or dual citizens. Like I'm working on a case right now where there's a Costa Rican client, but they're a U.S. citizen. So we got to quarterback the whole thing, and we have to, get the tax advisor here in the U.S., get the, the assets that were in Costa Rica and translate them over here. It's an inheritance situation, so you got to get there are some trusts involved with it. So you have to get some specialists. We don't have that in-house. Before in banking, when I was with the banking industry, we had those resources in-house. Today, the family office, we have to quarterback everything. We just go out and we find the resources and we apply them to our clients at an efficient cost, basically.
I guess sharing the network is a great example. Where would you find the professionals? Yep.
Yeah, I'll add to that as well. Steve was talking earlier about all the different things that can be thrown at us from an investment perspective, right? And we're talking about tax right now. But one of the things that I'll share with my clients is control what you can control, right? And tax is one of those, right? I mean, we can't control what the tax rate is or anything like that, but we can control how we attack that problem, okay, or that particular issue. And so talking through that, we look at different things from the standpoint of, does the family have qualified plans? How do we navigate around that tax time bomb that exists there? Because that's going to be double tax when it transitions from one generation to the next. Show them strategies that they can navigate around that. Or if they have entities within the family office structure where they don't want to realize the tax of the income that's coming in from that particular organization, we can show them ways where we can create new cash flows, actually spin that income off into a tax-free, risk-free asset that's leverageable on the back end, again, with significant tax benefits tied around that. So we're not coming in, as you guys are, with capital deployment and things like that. We're coming in on the back end with the result of all those investments that they've made and helping them navigate around the taxes there.
For family offices and for individuals, the old adage applies. It's not what you make, it's what you keep. And so when you think about the tax environment, whether you're looking at it from the lens of a Canadian looking at America or through any other lens, the reality is taxes are part of the overarching equation of the playing field. And as a result, family offices think about structure and assets and who's in what's name and so forth. And that's important, getting it out of estates and so forth. And they think about investment choices and different strategies. So coming back to the root of your question, taxes matter a lot. And whether you're talking about estate taxes, income taxes, taxes across America in different jurisdictions, real estate taxes, it all factors into how family offices and the rest of us think about optimizing what we have. So it's very important in America for sure.
And to piggyback, I think on the point you guys are making, I mean, it's the challenges of doing cross-border transactions. A lot of times you'll see these different opportunities, but the tax implications are so challenging just to take the cash back to the country or something along those lines.
Absolutely. That's how I got restaurants in Miami. Didn't want to take it back to Canada. So obviously crises present opportunities. I remember my business partner started his foray in the Texas savings and loans crisis. And one of the things that stood out in his mind the most was not so much who he saw, was who he didn't see, which were a lot of kind of institutional competitors. But what he did notice were a lot of families. And I kind of thought maybe that's an agency problem where you are an analyst and you're trying to convince your CIO, do we go where every news says it's bad? Maybe your job's more important than LPs that you'll never meet. So I thought, families, because they are the principals, have an inherent advantage to act quickly. The next opportunity we had was in the referendum in Quebec when no one wanted to stay and presented unbelievable buying opportunities. But the flip side is governance, right? There's a lot of governance in institutions, and families don't necessarily have the same kind of structure on the governance. So I'm wondering if all of you guys can give me your take on, how do you work on the governance side, but at the same time try to stay nimble and flexible to be opportunistic?
Okay, I'll try. Look, I think your characterization is fair, but what I would say is that at least what we see for the larger family offices, whether they're first generation or multi-generational, governance is becoming a bigger issue. And the panel may have a different point of view, but maybe first generation, it is less important. You've got the founder, he or she made it, they're still very much in control. But as you get to as you get more distance from the founder, governance and frameworks actually matter. But I would say from the family offices we see, if I went point to point 10 or 20 years ago to today, governance is becoming more thoughtful. And I don't think it's bureaucratizing or slowing it down. I just think it's sort of like growing up. You have to sort of figure out how to do it over time. But
well, I was going to say there's two different dynamics that you have also. If it's a single family office versus a multifamily office, and to your point, Stephen, how many generations you have that are being dealt with that family office. So that's a significant challenge because you'll have different interests from an investment strategy, from philanthropy, things along those lines. But the other thing that we've seen with other family offices as well, it's also related to changing interests, right? So the difference when you have why you sometimes want strong governance, it helps protect sometimes the investment team or other folks from what the investment strategy will be. Because quite simply, I mean, there's one boss or there's several bosses, they can snap their fingers and priorities change depending on what's going on economically, personally, things along those lines.
Now, I think Bridgewater had or has a system where machines and algorithms would come up with the playbook of what the strategy should be in a certain situation, but the team would never do exactly what the machines and algorithms said. They made sure that they always had a human gut check and that they always had a willingness to break the rules when the opportunity came to it. We try to employ a similar situation, nothing on the algorithmic side, but at the beginning of the year, we set certain strategic objectives, including things like asset allocation to different classes. We'll have kind of a company-wide poll of what everybody thinks the allocation should be to different asset classes, and then kind of have a debate about it and set a target. But you also need a flexibility to know when the deal of a lifetime has come up, or when things 6 months later aren't exactly as they seemed at the beginning of the year, so you're willing to break those rules. And I think the way that we achieve that is by having a balance of conservatism and flexibility within different members of our team. And I'm talking both on the family office side and on the venture fund side. You have people that are either kind of academic in their approach or conservative in their approach, balanced out by people that are totally flexible, creative risk takers. And when you get all those people in a room together, and then you foster a culture and environment where debate is embraced, and you hope to duke it all out with each other and poke holes in each other's ideas in order to reach consensus, I think that's how you avoid a lot of the landmines, and you're able to seize on the best opportunities that come up.
We're structured a little bit different at ADI Dassler. We piggyback off a broker-dealer in South Carolina. It's called Apollon. And they do all our, compliance for us, all our asset distribution, asset management side of the equation. So since we're a multifamily office, it makes it just a little bit more, easier for us to be able to piggyback back off of them.
Absolutely. So I think, sadly, polarization is the reality of the world we live in right now. We have elections coming up, potential for a divided government. How does that kind of factor into the decision making when you're trying to think long term and legislation is important, and how do you think about that environment going forward?
So I'll jump in here. I mean, one thing that we look from an investment strategy, we actually don't try to take, there's obviously a lot of regulatory risk, there's a lot of government risk, legislative risk. When we're looking at investments, we try not to make investments in companies just because we think there's going to be a tax benefit. Because as quickly as the politics change, as the power in Washington, D.C. changes around the world, those things can change overnight as well. So where you think you're going to have this tax benefit or some credit, that's going to expire at some point. So we always look at the fundamentals of the business. Are these good operating businesses that regardless of what's going on, potentially, I mean, obviously, to Steven's point, you can't control every risk. but are these fundamentally good businesses in an economic downturn, in a tremendous growth opportunity, whatever those are, from a fundamental cash flow standpoint? Are you good management teams, good businesses, good strategic plans, operations? That's how we view it. So we try to mitigate that as much as possible, because you never know. You're never going to be able to predict who's going to win.
So we try to invest in things that are all weather, both in economic conditions and different policy environments. That being said, we are somewhat discouraged that one of the major political parties in the US hasn't embraced sixth grade level science around climate change for some reason or another. What we found, though, is that that anecdote is more applicable to the folks in Washington than the folks at the state level. So to the extent that we're ever trying to get things done with our businesses, our portfolio companies, we found that kind of regardless of political party, you can go to things at the state level, and because there's a greater degree of accountability to communities and to constituents, there's an ability to get stuff done no matter which way the political winds are blowing. So to the extent that we're ever trying to respond to policy, our response is generally that if the Republicans take the House and Senate, our policy focus is going to shift more to the state level. But as a more general matter, we're going to be investing in things that could survive any regime change that's happening, because the use case of the things that we're investing in are great, sort of no matter what the policy is behind them.
You know, when Biden was voted in, I remember a piece that I received from John Hancock, and it said, "Tax the wealthy has become the rallying cry of Congress." So that's the angle that we're going to come at this from. There was a lot of fear in the marketplace, and insurance became really popular as a result of what was going to happen from an estate tax standpoint, and also from the standpoint of current taxation as well. And it's a really difficult thing for us to pin down because it's a moving target, right? One of my clients told me years ago, a really bright guy, investment banker, he said, anything that can be legislated can be taken away. And so when we're dependent on what's legislated, it's like, this is our reality today. I don't know what it's going to be a year from now. I don't know what presidential administration, I don't know what's going to happen in the midterm elections. So again, we're always kind of chasing our tail when it comes to this, but it's our job to educate our clients and help them understand if this, then that, if that, then this, and help them understand the different paths that we can take and be reactionary to what's happening from a political standpoint.
You can't control who's going to get elected or what's going to get legislated, but you can control what you invest in, right, or what you don't invest in.
You know, I think the good news about America is that we are perpetually and relentlessly dissatisfied. So if we're red, we want to be blue. If we're blue, we want to be red. And in the moment, whatever one's politics, it feels either terrific or awful. But as we see often in midterm elections, whoever is in party, we sweep out the other side because we are firmly convinced there's got to be a better way. And so I think that's just the reality of the ecosystem in which we operate. And we can argue about whether it's worse today than it was 100 years ago or 50 years ago. And I think there are some things that are worse, but the pendulum swinging is as natural as can be. So we just have to adjust and accept that.
But actually, so this is one of the greatest opportunities family offices have, to provide that leadership that if we don't see it in Washington, we don't see in the business community, which I think we do see it a lot in the business community. But how do we bridge that gap? And that's one of the things, I mean, Trammell S. Crow is very much well known for in Texas, is how do you bridge the gap between the Republicans and Democrats to solve real challenges? And I think that's where family offices, I don't know if any of your family offices see the same thing or your clients from both sides, but I think that's where family offices can help fill that leadership gap that we need in this country.
Yeah, that's right. And obviously, you have an enormous nonprofit that you're helping to run. At a somewhat smaller level, we've created a partnership with MIT where they have a climate change simulation model that's called En-ROADS. It's basically a dashboard that can let any person solve climate change in a simulated environment, the same way a flight simulator might train pilots or heart surgeons might be trained in a simulated environment. We've been the sort of marketing team that's helped to roll out this model to now over 250 governors, senators, and members of Congress on a totally bipartisan basis, as well as over 1,000 CEOs and investors whose politics probably span the entire range, and it includes C-suites at oil companies and things like that. That's just using basic facts basic data, basic science, backed with the credibility of MIT and a family office that has reasonable bipartisan credentials, to go out and say, this is what the numbers are saying, act accordingly. And to be able to do that and create coalitions around it has created some interesting results, both on the policy side and the business side. So there is sort of always more ability to create impact than we might anticipate just off the top of our heads when we really get the ball rolling on some of these things.
Fascinating and inspiring, both Trammell and Michael, and everything you guys are doing. So moving from kind of the domestic politics to the foreign affairs, quite challenging geopolitical environment we're in when you look at the war in Ukraine, China continuing to decouple. It used to be think globalization, the world as one investing opportunity. More and more that's becoming challenged. How do you think when you're thinking about things outside of the U.S. and the geopolitics of the world, in terms of family office, of course?
Well, as I mentioned before, most of my clients are from Latin America, so the political situation in Latin America has gone completely left, especially with the elections yesterday, the result in Brazil. So most of my clients are just looking for stability here in the U.S. and they're conservative. Like I said, they've already risked a lot of their fortune in establishing their business and bringing their businesses up. So what they have is they want to just protect, and they want to protect it the best way they possibly can.
To piggyback on that, I mean, one of the trends that we're seeing a lot of family offices actually from Latin America and elsewhere trying to actually figure out how to bring capital to the United States from an investment standpoint, because they see it as more of a stable opportunity, especially in the private markets where they're maybe underexposed in their own geographies, but have greater opportunity in the U.S.
So fully agree with that. And we do have to keep in mind that 3 major policies were passed in the last year or so. You had the Bipartisan Infrastructure Act, you had the Bipartisan CHIPS Act, and then the more partisan so-called Inflation Reduction Act. All 3 of those being massive economic policies that at the end of the day are investing in U.S. innovation and U.S. manufacturing and jobs kind of at a scale that we haven't seen in a very, very long time. That means a couple of things. First of all, you are going to have a desire by families outside of the U.S. to bring money into the U.S. some way or another, and we're definitely seeing that as a really exciting trend right now. The other thing is that family offices have the ability to either collaborate with the government or in other ways take advantage of those policies in order to help grow businesses, create jobs, set up the factories of the future right here at home. And it is really exciting to think about what it means to really be investing in innovation that's not only going to create jobs and opportunities and economic growth here, but it's going to create technologies that are going to be exported all around the world. And that's part of the leadership that we hope to be a small part of.
I would agree with the sentiment. I think, again, looking at it in historical terms, if you went back to the Gulf War era, families outside the United States had some reticence about domiciling assets in the United States because they were worried about asset freezes. You look at it today, and it's the exact opposite. As crazy as we may think our politics are in the U.S., it's a relative game, and most certainly we're seeing some of the largest families in the world try to have a base of assets in America, safe, warm, and dry. So, we look at it through our lens and say we've got all sorts of issues and challenges and strife, and but if you're south of the border, it's sort of a relative game, and there's definitely a move to America as a beacon of safety at this point in time.
I guess we see this playing out in the currency markets with the U.S. dollar being incredibly strong right now. As a Canadian, I certainly notice it, but that would then present opportunities to take advantage of the strong U.S. dollar. Does that factor into any of your decisions in terms of currencies and just the opportunity and where we are right now?
We have gotten a couple of great deals in Canada and the UK.
30% off.
We paid less than we expected to, exactly.
You can get a really good vacation to Europe right now as well.
Absolutely. Interesting times. I guess we're coming close to the end. I was just going to give you all an opportunity to talk about, what the groups can take from the different families that you work with, and going forward, maybe the changing environment that we can plan for.
One perspective that I just urge people to think about is this whole digitalization and where does it take us? And it's permeating every aspect of our lives. Uber and Amazon and algorithmic trading and so forth. But I'll just give you this lens. When I was growing up, there were very few rules in my family. Be home for dinner, don't get hit by a car, no hitchhiking. And yet, today, everyone in this room has a phone. You're probably going to flip it up after you leave here. You're going to click Uber or Lyft, and you are going to jump into a car with someone you don't know at all, and you're going to think it's completely natural. Institutionalized hitchhiking. And I'm not critiquing that or judging it. What I'm saying is, for family offices and for all of us, reimagining what the future is in a digital world, because it is moving so fast and in so many different directions and permeating so many different dimensions of our lives that, we now sort of accept that Amazon, you need something and it can show up in your driveway in 2 hours. For my kids, 2 college-age kids, they think that's natural. For me, I'm still thinking I'm supposed to go to the store and, pick something up. So digital and how it permeates every aspect of life for family offices and beyond, I think will continue to be a huge theme.
I'll go next. I'll say, I think one of the points that I want to leave is think about the tremendous opportunity, regardless of your politics, regardless of what your views are, with the energy transition, a sustainability transition beyond just climate, but in all facts of our life, to the point of from the digitization standpoint. I mean, from the UN SDGs, there's a great report done by a UK group called Capital as a Force for Good. We need $176 trillion to hit the UN SDGs. Just let that number, obviously $1 trillion or billions don't, when you look at all the legislative actions, that doesn't seem as large anymore, but $176 trillion. But here in the United States, thinking about it from an energy transition, we used to spend around 10% of our US GDP on our US energy supply. 2 years ago, that was 5%. At the same time, we're going to need 20 to 40% more electricity here in the country because of the digitization, because of all the trends that are happening. That is a fundamental investment gap that is worth trillions of dollars for large family offices, the private sector, various organizations to get involved with. So what we see is how do you share this opportunity, put the noise away, show that sustainability shouldn't just be a box you want to check and make sure you feel good, but you can actually use it to drive value. You can use it to drive profitability, especially when you're going into an economic downturn. And I think that's what we see as a tremendous opportunity from giving people access to resources that I think a lot of us in this room take for granted, but also giving people the opportunity to have a new generation of wealth opportunities for people who haven't benefited from the last 50 years of growth.
In one of Bob Dylan's first original songs he ever published, he described the world. He said, "It's tired and it's worn. It looks like it's dying, but it's hardly been born." And I often think about that line in the context of the world today. We obviously get a lot of news headlines talking about how awful things are, and in some contexts, things are risky and bad, and a lot of lives are being impacted in negative ways. Yet it's hardly been born at the same time. The opportunities ahead of us in technology and innovation are kind of one of the things that keep me quite optimistic about our ability to solve the challenges that we have. Climate happens to be the one area that I'm focused on. And again, we are not on pace whatsoever right now to hit the emissions reductions that we need to over the next 10, 20, 30 years. But what keeps me optimistic is seeing the technological innovation that could happen that could really accelerate that transition. That means that something that's one of the biggest challenges in the world today also represents one of the greatest business opportunities that we've ever seen. There are, of course, other areas where we might be able to say that, but with climate, we're quite excited about it, and we're quite excited about our ability to possibly bring in other family offices to help be part of the solution.
We're going to quote song lyrics. The Notorious B.I.G. said, "Mo money, mo problems," right? So in that context, I want everyone here to really understand life insurance as an asset class. Okay, it's incredibly diverse. And a lot of people have preconceived notions as to what it is. There's been a lot of research and development in the space. From a capital appreciation standpoint, a lot of these policies are essentially tax-free structured products with a death put. You wrap your head around the power behind some of these products as fixed income alternatives, and it's really eye-opening. But aside from that, just understanding what it can do, like talking about using tax planning and legal structures in conjunction with life insurance to help you avoid paying taxes on your exits or your income, whatever it is, to help you allocate your capital the way that you want to, instead of leaving it to politicians to allocate it the way that they want to, right? And when you start to really understand the value proposition behind real estate, it's an incredibly powerful asset class. And that's the thing. That's what it is, guys. It's an asset class. It truly is. It's not a product. It can be used in so many different ways. And so I just want the families here to embrace that and to be open to having a conversation, to understanding it and how it can impact them and future generations.
I guess that's the kind of theme. None of these things are products, but they're all, solutions. And we're facing a lot of problems. And as Ben mentioned, we are not where we should be. But hopefully today's panel provided some hope as to how families of the world can work together, collaborate, share best practices, and try to make the world a better place. So thank you guys so much for giving your time today.